Hey, Facebook Live people, welcome. I'm John Dobis from Forbes, coming to you from the MoneyShow San Francisco, talking with Bob Lang of ExplosiveOptions.net.
Good to be with you, John.
Talking to you about, how you make a few bucks in options. The Black-Scholes model has all these different Greek variables in it, and it's Greek to a lot of people, but volatility and the movement of the underlying stock price and what it causes in the options prices and delta and all. What Greeks are important to you, and how do you interpret them to give you an edge in what you're doing?
Well, the edge that I'm looking for, John, is about probability. I'm looking for the best probability trade. A lot of people look at options trading as just gambling. And I like to think I have a little bit more thought process going into it than just stepping into a casino, right? But frankly, options trading can be used to build a great deal of wealth because they give you an enormous amount of leverage, but you have to do it smart.
Right.
And but the gambler out there is going to look at something that's a very low probability bet, okay, but can pay off.
Huge payoff, right?
Huge payoff, right? But they're always looking for that. It looks like you go to the track and you bet on the 90-to-1 shot every single race, right? How many times are you going to win that? You go to the track. You have 9 races. You bet on that 90-to-1 shot every single time. You're probably going to walk away a loser.
Right. Exactly. Bet on the best horse.
Well, that's the same way with options, with low volatility or low delta trades. So we talked about the Greeks a moment ago. So the one Greek that I look for is the delta. All right, and the delta simply is how much is that option going to move with a $1 move in the stock? Okay, so if Facebook moves from 125 to 126, and I've got an option that's got a delta of 26, that option's going to move 26 cents. Well, if it's trading at $1, it's going to move 26 cents to $1.26. Do the math. That's a 26% return on the option, where the stock only moved $1 versus the.
But if you have a call that's in the money, yes, the delta's close to 1, right?
That's correct. Right. So what I think is it's a smart thing to do with options and delta is to buy higher deltas, not the lower deltas.
Right.
You're not going to get the kind of payoff that you would get if on a low delta trade where it jumps a large amount. Let's take a look at 58.com, which traded earnings on Monday morning. The stock jumped $10. Right. If you bought an out of the money option, you made a killing on that.
Sure.
Money. But if you even bought an in the money option on the stock with a higher delta, maybe a 35 or 40 delta, you still made a really nice profit on the thing, and you didn't have as much money.
Yeah, instead of a home run, you're hitting a double or a triple, but
That's
you're
right.
not striking out as much.
Nothing wrong with that. You just keep hitting the singles, doubles all the time.
So do you find yourself often buying in the money call options then on a stock that you do like?
Well, in this environment of low volatility, I think buying at the money or in the money options is a smart way to go.
Just the leverage, right?
Correct. When volatility is up or rising, those options are getting more expensive, right? So normally, if you're buying an at the money option with volatility currently right now it's 11%,
right?
Maybe it'd be $3. With volatility up, say, 17, 20%, right now you'd be paying $5 for that.
Right.
You'd be probably paying 40, 50% more for that option than you would be today.
Gotcha. See, stocks, indexes, futures, what kind of things do you get into as far as the underlying securities?
Well, I generally like to play individual equity stocks, and then
right.
I'm also trying to buy. I always like to buy some protection when volatility is cheap. Like right now, the VIX is about 11%. Mm-hmm. Options are cheap right now, so it's cheap to buy some SPY or RUT or some QQQ or even the diamonds, which is the Dow Industrials, some at the money puts.
Right.
Just in case what happens. Look what happened about a week or so ago when the markets got blasted on the 17th. If you didn't have any protection in place, your portfolio, got
But if you keep on paying for that protection when you don't need it, after that'll be a big drag on returns.
Sure.
It's kind of a you have to weight the outcomes.
I call it a necessary evil, right? Don't you have insurance for your health and your car and your life and
right.
your home? You have all that stuff. You wish you didn't have to pay it, right? But if something happens, you're glad you have it there.
True. Thanks a lot.